The biggest money in the world is not driving down the price just for kicks and giggles. They're doing it specifically, I believe, to corner the physical supply. And look at what these big traders are doing. If you look at the gold market as an example, they drove the price down into the 1750s and then took massive possession off of COMEX. They're using the lowered prices to accumulate huge amounts of gold and silver. It is incentivizing them to take delivery of it. The mints cannot keep up with demand. And I have been told by a relatively reliable source, we're one of only 27 authorized resellers in the world for the United States Mint. So I have some pretty good sources. This hasn't been validated or verified, but I would say it's a very good source who told me the U.S. Mint is planning on going offline for up to 2 months in April. Offline completely to retool for the new Type 2 Eagle series. My question to him was, why the heck would they do that? It made no sense to any of us why they would do this instead of just finding a way to retool for, on the fly. So you pull out the U.S. Mint as an example, if that were to happen, for 2 months, you've just cut off 20% of global supply.
This is Dunnigan Kaiser, founder of Liberty in Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty in Finance. We're glad to have this returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us this Tuesday, March 2nd, 2021. Andy, thanks for coming back on for this weekly update.
Nice to see you again, Dunnigan. Always enjoy our time together. Thanks for having me.
There's certainly been a lot going on. It seems like some people say, gee, it's the same thing I heard last week. And other people say, oh my gosh, thank you so much for this information, because people are hearing new things in new ways. There's revelations that we're getting that are, secrets of the market being revealed, or behavior patterns in purchasing or in the supply chain disruptions in this strange COVID-related time that seems like there'll be no end to it. But we wanted to always get back for your weekly market update. So could we start from a very, very high level and zoom in then on some specific viewers' questions afterwards? As far as you've been appearing on a number of different shows and some panels with other guests talking about some of the things that are being revealed about dynamics in the silver market, especially around the COMEX. And I just saw a story that just came out yesterday saying that there will be investigations, official investigations into the crowdsource type market participation by individual retail investors as potentially prosecutable for market rigging or manipulating markets. And it's like, what a forehead slap moment that was for me after the years of interviewing Bill Murphy from GATA.org and others, Chris Powell and others who have been investigating concentrated, powerful market forces for decades or more. But could you at least tell us what your latest observations are about maybe the silver market or the COMEX market, gold and silver in general?
Yeah, I find that to be completely laughable. I mean, you have 8 traders right now, commercial banks, that are short roughly 50% of the entire open interest in COMEX. Talk about a concentrated, position or a concerted effort to suppress the price. That's just laughable in and of itself. The action on COMEX is completely disconnected from the action on Main Street. And we've talked about before, on February 1st, we saw 1.5 billion ounces of silver dumped at the open, specifically intended to freak out the Reddit group, the new Johnny-come-latelys who came into the marketplace. The manipulative action on the COMEX market is nothing new. The coordinated effort by Wall Street Silver Group which has been done legally, morally, ethically, is anything but illegal. It's just a bunch of people who are talking amongst themselves, coordinating legally, doing nothing immoral or sneaky or underhanded, and they're transparent about it. They say, look, these positions are short a tremendous amount. It's unjustified. Let's go and buy it. And by doing so, it disrupts the major short positions who just happen to be commercial banks and hedge funds. So, it's more of the same. The demand, however, for physical product, both gold and silver, is insatiable. It's unlike anything we've ever seen in the industry. February was my company's largest month in 31 years, ever, and for a short month at that. And I know the same thing is true with all the online companies as we see their inventories completely and totally depleted. When you see the amount of deliveries coming off of COMEX as well, that's something to pay attention to. It's also interesting to note that in February, we saw massive amounts of exchange for physical deliveries where instead of it coming off of COMEX in silver, they're taking it in, exchanging it into London. And that may be the theory here is that the COMEX said to these big players, stop taking metal off of COMEX, you're breaking the silver market. And so huge amounts of silver deliveries were shifted through exchange for physical EFPs into London. Massive amounts this delivery month for March. But it's also interesting if we go back and look at the February delivery month, huge amounts of gold taken off of COMEX this time. Now, gold had not been delivered as much over the last several months. And with all the focus on silver, they moved the deliveries into London instead of off the COMEX, which had relatively small amounts of deliveries, massive exchange for physical in London, but massive deliveries of gold here on the COMEX. Now they're going back to gold. The same thing is true. You're seeing these very sophisticated investors, the sovereign wealth funds, the family offices, this others reportable group, continue to do more of the same thing. Now they're just taking gold off of COMEX, as that's been somewhat forgotten as the focus has been in silver. But the silver, they're kind of blurring it and taking it in the exchange for physical category in London. This is the way for them to continue to drain the coffers of physical supply, but do it in a more clandestine manner. Moral of the story, Dunnigan, is that stuff is disappearing. And whether it be at the very top of the food chain, when you talk about the LBMA or the COMEX, all the way down to us little guys here on the street who are selling 1 ounce coins, I don't have to tell you how challenging it is to continue to find new product, which is rotating and changing daily. But we see it from the top on down, and I guess I would simply say the same thing I've said for a very long time. Price is a tool of misdirection. They are misdirecting all of us with price and rhetoric and using that manipulative environment to secure copious amounts of gold, and silver, whether it be deliveries of gold off the COMEX or silver exchanging for physical off the London Metals Exchange. The result is the same thing. Big money is taking delivery of metal, and that is what is so unusual. And, I take it's almost an insult, like you said, a slap to the head, for them to say we're going to investigate crowdfunding and crowdsourcing. That's just a bunch of crap. How about investigate the 8 commercial banks that control 50% of the silver market? There is not another commodity traded on the commodity exchange that has that type of concentrated position. It's wrong, it's disingenuous, and it's just more of the same thing. The moral of the story is that we will not beat the COMEX. We will not beat SLV. You're not going to break them the way that you break them, because what they will do, the exchanges will change the rules, they'll cash settle, they'll do everything to thwart that. And you can see that by this nonsense. But how you win is you just keep buying physical gold and silver until there's none left to be found. The futures market and the paper market, the ETFs, they have the big banks and the regulators on their side, and that's been proven. The only way to win is to pull all the investable silver that we can off the table. And as that happens, you will see it become more and more and more, I think, in focus as to just how much of a sham this paper market truly is, and how they are completely creating a marketplace through paper that is non-reflective of how difficult it is to actually secure product. And so it's more of the same thing, but I will tell you that the environment is completely different, and the awakening by the mainstream is completely different, and just how much metal is being delivered and the lengths that they're taking to blur that is just more, I think, more crystallizes that type of thinking.
I had a conversation with a new client who was reporting what I think is probably a very common thought process that Rick Rule has told us about, and that is the most common thought process for the retail investor is typically recent price action. So the person said, well, after all, we're in a gold bear market, for example. And I had to take a double take, and I said, what? He said, well, and we talked about, oh, okay, so it's down. Gold price has moved down over the past several months. Okay. But we talked about, what's the broader picture of that, as Rick Rule has talked about, or the individual also reflected how it's difficult to get yourself ready to put your life savings or your nest egg into metals if you see that, gee, they can drop 5% or 10% or whatever. It's like, well, why not wait till it's rising and that kind of thing, rather than when it's been going down for a while. And it's just a complete different mindset. Rick Rule has talked about that. He says if you already understand the underlying intrinsic value of something and you see it go on sale, you pounce. Whereas if you're just watching price momentum, it's a completely different way of thinking. And the challenge seems to be what I've encountered with so many people who are new first-time buyers in the past month that I've spoken with, is then the frustration that they experience, and we talked about this some last week, of what it's like to be a buyer when the crowd is buying. I mean, you said, like when the crowd was clearing out the toilet paper aisle at Costco, that's not a fun place to be a first-time buyer. Or whenever there's a crowd pressing into one of these stadium stampedes or whatever, it's a very unpleasant, frustrating, distressing experience for people. So, but it's the position that people seem to put themselves into if they wait to make sure that the crowd is moving in that momentum before they jump into that. Maybe you can talk a little bit about the overcoming that natural human temptation to only do what the crowd is doing, and why that makes for a more challenging buying experience, rather than understanding that intrinsic value is very different from current price action.
Yeah, well, real quick before I do that, since you mentioned his name, Rick Rule has meant an awful lot to me in my career, and my relationship with him and Sprott has been something I'm very proud of for the last 20 years, even before he was Sprott and Global Resource. I know he just publicly announced his retirement of sorts yesterday, and I'd like to just congratulate him and thank him for everything he's ever done for me and Miles Franklin. He's quite a guy, one of the smartest guys I've ever known in this industry. We should all listen to the things that he has to say, but that's just exactly it. As I was saying, price is a tool of misdirection, and if the big money realizes that they can control sentiment simply by controlling price, you need to look under the hood. The old adage, don't judge a book by its cover, but that's what everyone's doing. They're judging the book without reading chapter 1 or page 1 for that matter. They're just looking at the price and not doing the legwork, looking under the hood, seeing what it's all about. And so, yeah, I think in general, it's very easy to control sentiment by pushing the price around. And I think, the old adage, buy low, sell high, you should take advantage of these subsidized prices if you understand the inner workings of the market. The problem is too many people are following the crowd rather than doing a little bit of legwork on their own and finding the real reasons to own it. It's not about profit. It's about preservation. It's not about as much wealth creation as it is wealth preservation. Now, you will make some money, certainly, I think, in places like silver, and darn good chance of making an awful lot. But when this type of insurance is going on sale, when the world around us is aflame and getting worse, yeah, you should be thankful that the price has decreased, that the manipulation of the price is still intact, and look at that as a subsidy, because you know what? That's what the biggest money in the world is doing. The biggest money in the world is not driving down the price just for kicks and giggles. They're doing it specifically, I believe, to corner the physical supply. And look at what these big traders are doing. If you look at the gold market as an example, they drove the price down into the 1750s and then took massive possession off of COMEX. They're using the lowered prices to accumulate huge amounts of gold and silver. It is incentivizing them to take delivery of it. So, look, price and fundamentals have been disconnected in many levels, not just in the precious metals market. Look at the inverse of that, and look at a Dow Jones trading at all-time highs when the economy has been eviscerated. It doesn't justify it, and people don't complain when the justification is the other direction, and they don't look under the hood there. There's nothing to see here. Look at grab your equity statement and keep moving. The same thing is true here in reverse. The big money is using misdirection to throw us off the trail. They don't want us crowding them out of their trade. They don't want us dumping dollars in favor of alternatives when the environment really dictates that we should be. So that's a big one, and it's a tough one. But I think the bottom line is if the fundamentals justify accumulation of precious metals and ownership of it, then the price is really not that important if ultimately we know where this is going. Now, people may say, well, it's easy for him to say that. I mean it. I really do. And as I've told you on this show, I've been buying every 2 weeks for 31 years. I have never missed a 2-week period, and I don't know what I paid for 97% of what I own. And in the end, it really doesn't matter. It's about the number of ounces that you own. So accumulate on the dips. Don't chase the rallies. On Wall Street, they say buy the dips, sell the rips. So don't buy it when it's going up, but collect it at subsidized prices when they knock it down in a very counterintuitive fashion to what's happening. And that's exactly what is happening. People's frustration is that, well, how the hell could this be happening? It's so counterintuitive to what my eyes are telling me. Well, that's exactly what they're trying to do, to misdirect you as massive deliveries are coming off of COMEX, as commercial banks are gobbling up tons of it, as central banks are gobbling up tons of it, and as the retail public is massively accumulating it. Price and demand have been disconnected temporarily. Won't last forever, but yeah, when things go on sale until the fundamentals would dictate we look somewhere else, it's a subsidy. We should be happy for it.
Well, the flip side of that is that once the table turns, and the momentum is in the upward direction, and you get a few more percent, as you've mentioned in the past, a few more percent of the population waking up to this, then, heaven help all of us trying to get physical to sell, to buy, to acquire for people who are starting as newbies. But you mentioned some really big players in there and the central banks included. You've talked to us a couple of times in the past. You said it's the most pivotal event in your career of 30 years is the BASEL III Accord, where the central banks met to talk about reclassifying gold as a Tier 1 asset. We have both two viewers have asked this question. One is Ivan Gaeta, who says, are the Basel III gold requirements still in play? And JR said, is it true that this June 2021 in the U.S. is when the NSFR, the net stable funds requirement, goes into effect in the U.S.? What's the importance of that, and what are the key dates that are coming up?
Yeah, the Basel III reclassification of gold was absolutely the biggest event in my career, and it puts it in greater context when you realize that before Basel III was announced, or at least the gold side of things, April 1st of 2019, the central banks massively were accumulating it for 15 months before that, front-running the decision. The net reserve requirement that you speak of does go into effect in June. It was supposed to go into effect in 2018, but the banks haven't been able to meet those requirements, so they keep pushing it out and keep pushing it out, and it is supposed to go into effect in June. What it basically says is that these banks and these institutions are supposed to maintain an 85% equity position to on and off balance sheet positions. How that would impact gold would be the London Metals Exchange is a non-allocated exchange. It is also affected by the allocation, the 85% equity to balance sheet issue. And what that will do in theory is raise costs on the LBMA. It will create, some people will leave It will leave the marketplace, and it will, in some respects, I think they're concerned about drive the price discovery to more of a allocated price setting mechanism. Maybe the Shanghai Gold Exchange as an example, where Shanghai is mostly cash and carry. They do have some exposure to futures, but they are mostly cash and carry. So the bottom line here is that if these banks don't have an 85% equity to on and off balance sheet position in a unallocated position, in an unallocated futures market, LBMA market, that you'll see players leave and the costs rise and more people moving to a different mechanism. And some people believe that will be the end of the Western price setting charade. So whether that happens or not remains to be seen. But certainly the fact that we are seeing these regulations come into play June 1st, I believe, is very significant. And because we are beginning to see more and more reasons why these banks are messing with fire by continuing to try to manipulate the price with naked futures contracts. So yes, it is happening. What will happen remains to be seen, but it will directly affect the London Metals Exchange because it is an unallocated market, and they will, in theory, anyone who trades on it will need to have 85% equity to their position, which right now is a fraction of that.
All right. This is just Max Bauckley said basically what you were saying a few minutes ago. The fiat insurance, gold and silver, the banks are selling is cheap at the moment. Very few people see the fiat future. The insurance costs will go up when everyone needs it. Patience.
Yes, that's exactly it. The costs will go up, and so therefore it will not have the same level of liquidity that we see right now. And you'll see players leave because they will not be able to meet those Basel III margin requirements. And so they'll just leave. And now you'll see more of a drive towards, instead of the LBMA perhaps being the biggest center of metals on earth, maybe it moves to the Shanghai Exchange. I think that is one of the fears that they have.
Okay. We have a question here about, you've talked with us about metal swaps in the past, people who are interested in sometimes if they still feel that the gold to silver ratio is higher than the historical average, which it is, that they might want to sell gold now and get into silver and then ride the silver elevator up and then swap back into gold in the future. But you've also mentioned that there are certain considerations when doing a swap as far as when you can carry your basis forward versus when you have to recognize a capital gain. This question from Bill Phillips says, I have 100-ounce silver bars and would like to change them in for 90% constitutional silver. What would the tax and reporting consequences be? Is it considered a like trade or equal swap and not considered a taxable sale? I think there's two different questions there. One is about reportability, selling bars. The other is about taxability of a taxable event for a swap.
Yeah, that's a like-for-like exchange, silver to silver, apples to apples, and would be a non-reportable transaction because they are trading. They retain their original cost basis and carry it forward. So it is not selling, would not generate a 1099, even though selling 100-ounce bars in excess of 1,000 ounces in one occasion would be a 1099 event. But if they're trading it for a different form of silver, ounces to ounces, carrying over their initial basis, it's a like-for-like exchange, non-reportable.
Okay, you just expanded my mind a little bit. Okay, so the 1099B reporting, the whole purpose of that is being able to prepare for accounting of a capital gain, but there's no capital gain if you're doing a like-for-like swap.
Carrying over your initial
basis.
Correct. Now, in some cases, let's say, for example, that the person had bought that silver at a much higher price and they want a taxable loss. Mm-hmm. So they could do two separate transactions. Now, in securities, if there are any securities brokers out there, they would know, well, hey, wait a second, that's a violation of the 30-day wash rule.
Right.
But that's not the case. The 30-day wash rule is a securities terminology that says if you sell something and claim a loss, you cannot buy it or anything similar back for 31 days. And the reason is, imagine someone just sold a very wealthy person sells an investment property, has a big gain, and they want to wash it with selling something they have a loss on, even though they don't want to get rid of it. So they could sell that item in their portfolio, book the loss, offset the gain, and buy it back for a nominal event fee. In fact, most most managed accounts now, they don't even carry cost per trade. So it would be a non-cost event where you could sell one, wash the gain, buy it right back. Well, the government says you can do that, but you can't buy that back for 31 days. You got to play the market risk. Doesn't pertain to commodities. It's only securities. So here in that example, someone bought 100-ounce bars at $45 an ounce. They could sell them, book the loss, and with the proceeds, without even writing a check out to buy the constitutional silver, use the proceeds to buy the constitutional silver. Now look at what you've just achieved there. Number one, legally you wrote off a loss that you can write off against other gains if you want. Number two, you sold it, you booked it, you did everything you're supposed to do. The only loss in privacy in and of itself in buying precious metals in theory is writing out a check or sending a wire, neither of which you will have done in this example because you used the proceeds of the sale of the bars, which you told the IRS about, told your accountant about. Hey, I sold X amount of bars, and no one ever says to you, what'd you do with the proceeds? I would say to my accountant, none of your business. I used the check to wallpaper my kitchen. It doesn't matter. No one's going to ask you what you did with the proceeds. So you take the proceeds of that sale and apply it towards your new purchase. Legally, you just ended up with a tremendous amount of privacy because you took the proceeds, you put it into a different form of silver, and now you never wrote a check out to buy it. It's in essence legally invisible. So there are other little side benefits to this transaction, mostly being privacy. But would be no tax reporting on our end in terms of a 1099. And as long as it's apples to apples. If it were from bullion to numismatics, may not be the case, but if it's from bullion to bullion, it is the case.
Okay. This question is one that's on a lot of people's mind these days as they are finding out that premiums are a lot higher on most retail investable forms of metal than usual. Eric Hoffner has two questions. Andy, when do you see silver premiums coming down to more normal levels is the first question.
Well, we always talk about what Rick Roll says about the 1980, there was an 8% allocation across the whole financial matrix from the individual investor all the way to the Harvard Endowment Fund, 8%. And that was when the last time we saw gold and the Dow Jones cross at 850, one-to-one relationship. We go to January 2020, before COVID hits, it's 0.5%. And I would, if you look at that 40-year period, the average or the mean is 2.5%. And statistics will dictate that we will regress to the mean. And I would argue we are regressing to the mean. We are. The demand is way higher than anything I've ever seen. And we're seeing a more accentuated segment of the public buy metal. So we're getting closer to that average, that 2.5%. But what happens if it goes to 5% or 10%? What if 10% of everyone's portfolio went into gold? You have $1 million, you put 100,000 into gold and silver, which isn't outlandish. In fact, I spent many years in Switzerland, first 3 years of my career, learning about Swiss investments because that was the focus of our business. And I never met a Swiss banker in those 3 years who wouldn't tell me in the best of times 10% of your assets should be in precious metals. So let's say it goes to 10% because these aren't the best of times. You're looking at a 20-fold increase from January 2020 to then. A 20-fold increase in demand at a period of time when this market, due to recency bias, has no chance in the world of being able to handle that type of logistics. So 5%, well, at a 5% allocation, you're still at 10 times increase in demand. 2.5%, which is the average, that's a 5-fold increase. So I ask you this, when does it change? I don't know. Everything that I'm buying, and we're one of the only companies this whole time, Dunnigan, who's had supply, and you'll vouch for me on that. A lot of companies have had some supply. We've had better supply than most. But in everything that we're buying, we're paying the highest premiums to buy it. And I'll get calls from my trader, Ryan, who will say to me, Andy, I need a decision from you. I can buy 55,000 kangaroos, but, they're at the highest premium we've ever bought them at. What should I do? And I have to think real quick, what do I do? Because if what your listener asks me and the premium does go down considerably for whatever reason, I'm out. That money, I can't hedge that premium. I can only hedge the market exposure. So the answer is I don't know. But if I had to guess, unless things get substantively better sometime soon, they're not going to come back down. They're going to continue to go higher because the mints cannot keep up with demand. And I have been told by a relatively reliable source, we're one of only 27 authorized resellers in the world for the United States Mint. So I have some pretty good sources. This hasn't been validated or verified, but I would say it's a very good source who told me the U.S. Mint is planning on going offline for up to 2 months in April, offline completely to retool for the new Type 2 Eagle series. My question to him was, why the heck would they do that? And his response was filled with 4-letter expletives that I won't say on this show, but it made no sense to any of us why they would do this instead of just finding a way to retool for, on the fly. So you pull out the U.S. Mint as an example, if that were to happen, for 2 months, you've just cut off 20% of global supply and the majority of the North American supply. As is, the Royal Canadian Mint has also been the model of inefficiency. Their maple leafs are priced higher than I've ever seen them, and their gold maple leafs, the silver are, and their gold maple leafs are 4+ weeks out on 2021s. That's a guess. So as it is, the mints are struggling completely and totally to keep up with demand. And what I see coming forward, both in the form of growing and increasing awareness by the public and demand for metal, and also inefficiency by the mints and stupid decisions to boot. So to answer the question, I don't know, but I would not bet on them coming down anytime soon. And as a footnote, we are paying the highest premiums we have ever had to pay to buy coins. We're selling them at the highest premiums we've ever had selling coins, but we're also buying them back at the highest premiums also for the 1 in a million people that want to actually sell something.
So here's a related question from the same questioner. Andy, isn't gold a better buy right now since silver has such high premiums?
No, it's not. I mean, mathematically, even with the premiums involved, the historical ratio between gold and silver for the last 150 years is about 45-1, historically. And so right now we're, roughly 66 or 67-1. I haven't done the math yet today, but historically silver is wickedly undervalued. You can even add the $5 premium per ounce and you're still way under what we should be. Let's just do an exercise here. I'm going to look down at my phone just to answer that question properly. If we take 45-1 as an average for the last 150 years of a relationship between gold and silver, we take gold at 1735 and divide it by 2681. So 1735 divided by 26.81 is 64.7-1.
So that's without the premiums, right?
That's without the premium. So even with the premium, it's up a little bit. So it changes a little bit. But let's do it this way. Let's take the 1735 and divide it by 45. The very least silver should be right now is 38.55. Silver should be $38 an ounce right now, minimum, just to be in line with the 150-year average. And when I was on an interview with your son, Elijah, we were interviewing together Keith Neumeyer, who is the CEO of First Majestic Silver, one of the biggest silver companies in the world. And I asked Keith what he thought about the gold to silver ratio because we've been talking about this for a long time, Dunnigan. You and I were talking about it in March when it was at 120 or 125-1, which was the greatest disparity in human history ever. And we were begging people, imploring them, sell your gold, buy silver. It will regress. Well, it has regressed almost half. So anyone who traded an ounce of gold in March into silver could basically trade it back right now for 2 ounces of gold. Pretty close. You'll see it regress more. And I asked him that. Keith, what do you think about the ratio? And at the time, it was 80-1. He said, Andy, I don't think about that very much. I think about the mining ratio instead, which is 8-1. Globally, across the entire world, the mining companies are pulling out 8 ounces of silver for every 1 ounce of gold. What happens if we regress closer to that ratio? In other words, everything from the historical relationship between gold and silver to the mining ratio, which is saying that the numbers that we see are out of whack by as much as 8 times out of whack. In other words, if it's priced at 68 to 1, 8 times 8 is what? 64. There you go. So it's over 8 times right now undervalued in relation to its geological relationship to gold. So anyway you look at it, the answer is no. Silver is still a better buy than gold across the board, in my opinion.
In the spirit of what's valued or what's a good value, sometimes you are able to offer us a weekly special before we let you go. Anything that you can offer this week for our viewers? They gobbled up the silver Krugerrands you offered last week. You had like 7,200 in stock and more on the way, and the ones that were in stock were gone in a day and a half. So they can still buy those for the rest of today. But what have you got for us for next week?
Yeah, it's interesting. You and I were promoting, and that's a lot of what these weekly get-togethers are. I try to find something special that no one in the country can touch and offer to our listeners as a thank you for patronizing your show and Miles Franklin. And we talked about junk silver, pre-65 U.S. constitutional silver for a very long time this year, and we were selling it for $1.39, $1.49 over spot to the consumer. And just as a reflection of those high premiums and of the demand, and let's just remember one thing before I get to where I'm going with the silver, is that commission is part of premium. Our commission usually stays pretty darn close to the same. It's the premium. It is how hard is it for us or any other company to pry that out of the public's hands. And in no better example is that found in pre-65 silver. It can't be reproduced like a Krugerrand can. It can't be made. It hasn't been made, for 55 years. So how do you get it? Anyways, it was $1.39 a few months ago. Right now, I have 40 bags of pre-65 silver, dimes and quarters, and 10 bags of pre-65 half dollars. And if I sell them and offer them, which I'm going to, at $6.25 over the price of silver per ounce in dimes and quarters and $7.25 over in half dollars, that puts us in almost every single example as much as $2, $3, $4, $5 an ounce cheaper than everyone in the United States. It is offers the greatest utility of any form of silver. The dimes and the quarters do because of the small size. And the greatest flexibility. And for someone whose namesake in your show is preparation, part of it, this is the greatest way to prepare for whatever. If you ever had to trade, a lot of the things that have happened in the past year, I would have said there's not a snowball's chance in Hades of that ever happening. Well, a lot of these things that we never thought would happen keep happening. So what's wrong with preparing and buying something that gives you great utility? Normally, the reason it got its name junk silver is because it used to be the least expensive thing forever. And I used to buy it at under melt value and sell it to the public for just a little bit over melt value. Right now, that is not the case. Right now, you are beginning to see what happens when supply is dwarfed by demand. So at these premiums, they're high to what they've been my whole career, but are they? Are they high? Is it high when people are gobbling it up and you can't find it anywhere else for within a couple dollars of this? I will tell you this is the best deal in the industry right now for pre-65 silver. And if you're looking for a way to barter or to have that utility or that flexibility, it's the best thing out there. So I have $40,000 face value or 40 bags available of dimes and quarters at 6 1/4 over delivered, and 10 bags at 7 1/4 over of half dollars. And those will be a mix of the Kennedys, Walking Liberties, and the Ben Franklins. And so anyways, I think from a standpoint of utility and preparation, everybody should own some junk silver. And I used to say 1 bag per family member is a great way to do it. Whatever it is, whatever exposure you can get, if you're looking for a way to have great utility, this is your number one play.
And just to remember, people don't have to buy $1,000 face value. They can buy it in any dollar face value amount.
Yeah, and here's how you figure it out. You take the spot price of silver, you add the premium of $6.25, and you multiply that times 0.715. That's the number of ounces in a dollar's face value of pre-1965 silver. So there's 0.715 ounces of pure silver per dollar face. So you take spot, add 6 1/4 for dimes and quarters, or 7 1/4 for halves, multiply times 0.715, and that will tell you how much it will cost you for every dollar of pre-65 silver that you want. Let's say it comes out to 22 or 23, whatever the number is. If you want 100 face, it'd be $2,300 if that's the number. So you could buy 100 face, 50 face, 200 face, 500 face, whatever you want. But we have 40,000 face in dimes and quarters and 10,000 face in half dollars ready to go. And I think everyone should own it. It's one of my all-time favorite ways of owning silver. It used to be the most economical way. Now it's by far the most utilitarian way, and everyone should own some.
Yeah, I have to echo what you're saying as far as the utility for barter, for hand-to-hand transactions. We've talked about that with a lot of clients who are preparedness-minded. It makes perfect sense to them because when we talk about the difference in recognizability and trusted, it isn't what you like, it's what the next guy's going to trust. If you're thinking ahead strategically, you always got to think one step ahead in your planning, not just what do I prefer, what do I like the look of or whatever, but it's what is the next guy going to trust and what is going to be in the size that's going to give me the optionality. If I want to make a big transaction, fine. But if I want to make a small transaction, I sure don't want to be carrying a 100-ounce bar to a farmer's market to try to make a small transaction. But it's also government minted. It's got legal tender status. It's got face value marking. It's inherently recognized and trusted by people because they've seen it before. They know it has the ring. Rings like silver. Rings true.
Absolutely. And it's interesting. Take a handful of pre-65 silver, jingle it in your hand, then take a handful of the silver coins that aren't really silver now that we have in our pocket, and the sound is vastly different. You'll hear it right away when you say rings like silver. Mm-hmm. The coins that we have now do not ring like silver. Those do. You can tell real quickly what is silver and what isn't. But I do think it's really a fantastic way of owning it. And from a standpoint of transactional, a dime as an example, 14 dimes equal almost exactly 1 ounce of silver. So, it's pretty hard to find something that is a 14th of an ounce of silver a dime is, and a quarter being 2.5 times that, a half dollar being 5 times that. So, which just brings me to one more question for people to figure it out. Dimes, quarters, and half dollars all have the same amount of silver per weight. In other words, if you had a giant bucket filled with dimes, quarters, and half dollars all mixed together, any way that you can make $1,000, anyway, will be 715 ounces of pure silver. If they were brand new, never been circulated, it would be closer to 724 ounces. I think it's 723.7, something like that. The reason the industry uses 715 instead of 723 is that the theory is up to 7 ounces was worn off through 60 years of going through coin counters and pockets and drawers and ashtrays and you name it. So we guarantee 715 ounces per $1,000 face value, or 0.715 per dollar face value. And from a standpoint of bartering and trading and utility, there's nothing that compares to it.
Well, Andy, I see we're out of time for the weekly update. We actually went longer than we're supposed to. So thank you for hanging in there with us, and always for joining us and on behalf of all of our viewers here on Liberty and Finance.
Always great to be here. I'm always just a phone call away. I love our time together, Dunnigan, and I will fondly look forward to it again next week. So in the meantime, have a great rest of your week, and we'll talk then.
All right, take care. If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today. To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com. bullion sales, you'll see my name, Dunnigan Kaiser, my phone number, and my associate Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.